a surprising and bold move, Canada has made the decision to halt its $130 billion oil export pipeline to the U.S., an action that immediately shocked Washington and sent tremors through the global energy market. The relationship between Canada and the United States has been a cornerstone of North American trade, particularly in the energy sector. For decades, Canada has been the largest supplier of energy to the U.S., with the two nations enjoying a strong economic partnership built on shared resources, mutual benefits, and reliable trade. This move is not just a response to a momentary disagreement, but a carefully considered strategic economic decision that could shift the balance of power in the global energy sector. The long-standing partnership between the two nations is now facing its most significant rupture in modern history. The result? A dramatic surge in energy prices. Gasoline, oil, and electricity prices in the U.S. have surged to record highs, leading to widespread disruptions in everyday life. This action has created a domino effect throughout the U.S. economy, and no sector is immune. The immediate consequence is the shock to U.S. consumers who are seeing significant price hikes in essential goods and services. Gas prices are skyrocketing, and with it, the costs of food and public services. For the average American, these price hikes are impacting daily activities, from commuting to work to purchasing groceries and flying to destinations. Even more alarming, this energy crisis is just the beginning of what promises to be a long-term challenge that could have repercussions for millions of people in the United States. As energy prices soar, the impact on U.S. industries is immediate and profound. The aviation industry is one of the first sectors to feel the sting, as higher fuel costs lead to increased airfares, reducing demand for flights and making air travel unaffordable for many Americans. Meanwhile, the transportation industry, which depends heavily on affordable fuel, sees its operations crippled. Trucking companies, shipping services, and manufacturing plants all face increased costs, leading to disruptions in the supply chain and higher prices for finished goods. This increase in energy prices is not just a temporary inconvenience, it's a major economic shock that ripples through all facets of life. Transport, manufacturing, and other industries are now being forced to rethink their operational strategies in light of the rising costs. For many, it means that their profit margins are being squeezed and their production costs are climbing, all of which are being passed down to consumers. While consumers are feeling the immediate pain of rising prices, businesses are facing severe challenges as well. Manufacturers are particularly hard hit, as they rely on stable energy costs to keep operations running smoothly. From factories to supply chains, the entire industrial base of the U.S. is struggling. But perhaps the most concerning aspect of this crisis is that it's not just about energy. This is a broader issue that could further destabilize the U.S. economy, leading to an even larger financial and political crisis. With the U.S. now facing a critical energy crisis, Europe and Asia are stepping up to fill the void left by Canada's withdrawal. The shift in global energy markets is more profound than it might seem. While the U.S. once relied heavily on Canada's oil exports, this partnership is now on the brink of collapse. Canada's new energy strategy involves seeking out new, more lucrative markets, particularly in China and India, the world's largest and fastest-growing energy consumers. For Canada, this is more than just an economic reaction. It's a strategic long-term pivot. Over the past several years, Canada had warned the U.S. that its energy supply dominance would not last forever, especially as global demand for energy continues to rise in markets outside of North America. In signing long-term contracts with China and India, Canada is securing itself a future where it is no longer beholden to the U.S. for its economic stability. This global pivot means that Canada is now positioning itself as a global energy powerhouse, with plans to shift energy exports to Europe and Asia. In a world where energy security is becoming a central issue, Canada's decision to diversify its energy customers could change the geopolitical landscape forever. This not only impacts North American trade, but also shapes the future of global energy markets, potentially disrupting traditional power structures and offering new opportunities for countries outside of North America to step into the spotlight as dominant energy players. The consequences of Canada's decision are being felt across the U.S. almost immediately, and the fallout is far-reaching. States like New York, California, and Michigan are facing the very real risk of rolling blackouts, especially as winter approaches. Without access to Canada's hydroelectric power, these states could see their energy grids overwhelmed, leading to widespread outages and disruptions to daily life. The price of electricity has skyrocketed, leaving many Americans scrambling to pay their bills and adjust to the new normal of higher utility costs. But the energy crisis is just one part of the story. The economic consequences of this disruption are profound. Industries that rely on cheap and abundant energy are already scaling back their operations due to rising energy costs. Manufacturing plants are reducing their output, and the automobile industry, which consumes vast amounts of energy in the production process, is facing a slowdown that could have long-term effects on U.S. employment. The situation is compounded by the fact that the U.S. was not prepared for this disruption. Washington's failure to heed Canada's warnings and its reliance on Canadian energy has left the U.S. vulnerable to this sudden shock. The American economy is now grappling with inflation, rising energy costs, and the potential for job losses in energy-dependent sectors. While many are searching for a quick solution, it's becoming clear that the U.S. will have to make significant changes to its energy strategy or risk enduring long-term consequences. The U.S. is now entering what analysts are calling a challenging energy winter, as the country faces an energy crisis of unprecedented proportions. This is not a temporary glitch. This is a fundamental shift in how the country will manage its energy needs moving forward. Everything from gas, oil, and electricity to goods and airline tickets has seen prices surge in recent months, and the impact on everyday families and businesses has been swift and devastating. The inflationary pressures that are being created by these soaring energy prices are starting to squeeze household budgets, as families are forced to pay more for essentials like food, electricity, and fuel. For many businesses, this price surge is causing serious headaches. Companies that rely on low-cost energy to operate are seeing their profits evaporate as production costs climb. Small businesses in particular are being hit hard, as they struggle to absorb the rising costs while trying to maintain competitive prices. But the crisis is not just economic, it is also a question of survival. As the U.S. energy system becomes increasingly unreliable, Americans are beginning to fear the worst. The specter of rolling blackouts, unaffordable fuel, and the loss of jobs in energy-dependent industries is forcing Americans to face a new reality. The energy systems they once took for granted are no longer stable, and Washington's efforts to alleviate the situation seem ineffective. The stakes are high. The U.S. economy is facing a moment of reckoning, and it's unclear what path Washington will take to recover from this crisis. Will it find alternative energy sources quickly enough? Or will the disruptions continue to destabilize the economy for years to come? The answers remain uncertain, but one thing is clear. America is in the midst of an energy crisis unlike any it has seen in modern history. As the energy crisis continues to unfold, President Donald Trump's response to Canada's actions has been nothing short of chaotic. In the face of an economic and political challenge, Trump has escalated tensions even further by threatening Canada with a 100% tariff on cars. This outburst has heightened the already tense trade relations between the two nations and further undermined any potential diplomatic resolution to the crisis. Trump's rhetoric has shifted from concern to confrontation, with the president directly threatening Canada's auto industry, one of the country's most important economic sectors. Trump has demanded that Canada act to stop migrants crossing the northern border, threatening to impose steep tariffs on Canadian-made cars if Canada fails to act. This aggressive posture is just the beginning of a full-scale trade conflict between the two nations. However, Canada has responded firmly. Prime Minister Mark Carney issued a forceful rebuttal to Trump's threats, emphasizing that no amount of economic pressure would make Canada abandon its sovereignty. Canada's leaders have made it clear that they will not bow to U.S. demands, and they have rebuffed any suggestions of becoming a subservient trade partner. This stance on sovereignty marks a turning point in the relationship, as Canada shifts its focus away from reliance on the U.S. and towards greater independence in its political and economic strategies. In a dramatic display of defiance, Canada has even reopened its military strategy and is considering alternatives to U.S. defense contracts, including the F-35 fighter jets deal. The Canadian government's decision to reassess its military relationship with the U.S. signals that the trade dispute is not just about energy, it's about asserting Canada's political and economic autonomy on the world stage. In a move that underscores the Trump administration's America First agenda, the United States has suspended its financial contributions to the World Trade Organization, WTO. This decision aligns with broader efforts to reduce government spending and reassess commitments to international institutions. The U.S., traditionally a significant contributor, was expected to provide about 11% of the WTO's 2024 budget, amounting to approximately 22.7 million Swiss francs. This suspension places the U.S. under Category 1 arrears, limiting its representatives' roles in WTO bodies. The halt in funding raises concerns about the World Trade Organization's operational capacity and the potential long-term implications for global trade dynamics. U.S. airlines, once optimistic about a sustained period of profitability, are now confronting significant challenges. The combination of President Trump's broad tariffs and a crackdown on government spending has led to reduced consumer and corporate travel expenditures. This shift in spending behavior has prompted airlines to revise their profit forecasts downward and adjust flight capacities. The S&P 500 Passenger Airlines Index has declined by 15% this year, with major carriers like Delta and United Airlines experiencing stock drops of approximately 20%. While premium and international travel bookings remain relatively stable, domestic demand has slowed, partly due to economic uncertainty and safety concerns. Airlines are closely monitoring these trends, as prolonged demand weakness could necessitate further capacity reductions and impact profitability. The U.S. suspension of WTO contributions and the challenges facing U.S. airlines have elicited varied responses from international partners. European stock markets have reacted to U.S. trade tensions, with significant declines in automotive shares following the announcement of a 25% tariff on car imports. Companies like BMW, Volkswagen, and General Motors have seen their stock values affected, reflecting concerns over potential trade disruptions. In the aviation sector, global carriers are observing the U.S. airline industry's struggles, assessing the impact on international travel demand, and adjusting strategies accordingly. These developments highlight the interconnectedness of global markets and the far-reaching consequences of policy decisions made by major economies. Beyond the corporate sector, consumer behavior is exhibiting signs of economic caution. Indicators such as reduced dining out, shifts in shopping habits towards bulk purchases at discount retailers like Costco, and lower traffic levels suggest a tightening of household budgets. These changes reflect growing consumer uncertainty and a shift towards more conservative spending. Such behaviors are often precursors to broader economic slowdowns, as decreased consumer spending can lead to reduced business revenues and potential job losses. Monitoring these trends provides valuable insights into the economic climate and can inform both policy decisions and business strategies. In contrast to the challenges faced by the broader travel industry, the luxury travel segment is experiencing growth. Increased bookings among high-income consumers, driven by factors such as record stock market gains and rising real estate values, are providing a positive sign for the economy. Travel agencies report higher average booking values, and networks like Virtuoso are seeing substantial yearly growth in high-value bookings. This trend underscores the resilience of affluent consumers and their continued willingness to spend on premium travel experiences, even amid broader economic uncertainties. The luxury travel market is expected to grow by 5.2% in 2025, bolstering economic confidence. The convergence of trade policy shifts, airline industry challenges, changing consumer behaviors, and sector-specific growth areas presents a complex economic landscape. Businesses and policymakers must navigate these crosswinds with strategic foresight, balancing protectionist measures with the need for international cooperation. Adaptability and resilience will be crucial as industries adjust to evolving demand patterns and policy environments. The ability to pivot in response to economic signals, invest in innovation, and maintain consumer trust will determine success in this dynamic climate. In conclusion, the U.S. is facing a massive economic and geopolitical shift. Canada's decision to cut off energy supplies is just one piece of a much larger puzzle. As the world transitions into a more independent and multipolar global landscape, the U.S. must adapt or risk losing its place at the top. This ongoing energy and trade war is far from over, and it's clear that the consequences will be felt for years to come.